Half an hour away from the opens in Shenzhen and Shanghai. Hong Kong markets are shut. You're watching the China Show. I'm Yvonne Man with David Ingles.
Let's get to your top stories today. Asian stocks edging higher. That's ahead of the Fed decision, of course. Traders, though, remain, fairly split on the size of that rate cut or coming rate cuts and the likely impact on risk appetite. You do have mainland markets coming back online today, under pressure, as you can imagine here, as things reopen, of course, from a holiday. Stocks at a 5-year low, investors looking to further discount a series of disappointing numbers. And Iran-backed Hezbollah blaming Israel for mysterious pager explosions that killed several people in Lebanon and left thousands wounded.
Well, it is Happy Fed Day, of course, as we wait for this much-anticipated meeting. Perhaps one of the more rare Fed meetings that we're going into with so much uncertainty of really what the FOMC is going to do. Is it going to be 25? Is it going to be a 50? What are the dots going to tell us for the rest of the year as well? Keep in mind, though, we did see U.S. stocks hit that record briefly, and therefore we are seeing U.S. futures slightly in the green here this morning. Risk assets overall, you see stocks are catching a slight bid. It's really been led by the likes of Japan, but keep in mind, we mentioned about Hong Kong markets are shut for Mid-Autumn Festival. So is South Korea here this morning. Taiwan just coming online just slightly on the back foot. But Singapore, of course, we're watching those levels here right now. We're nearing the highs of 2018 for that benchmark in particular here as well. A lot of it has to do with what we've been seeing with this massive kind of reversal of the yen. After we saw it weaken about more than 1% overnight, we're stabilizing and strengthening a little bit now, but we're still talking about a 141 handle here this morning. Oil markets, Bitcoin, take a look at some of these risk assets, are still looking a little elevated here today. Dave mentioned some of the tensions in the U.S. when it comes, in the Middle East, I should say, that is keeping oil a bid here. And you take a look at how Bitcoin is doing. We saw a 4% pop here. We're back well above that 60,200 level here as well. And we're also watching very closely what happens with what swaps are saying, right? It seems like this market thinks at least a 50% chance or more that it's going to be a 50 basis point cut by the Fed later on today. Yes, it's all about the China reopen as well. We were shut for a long weekend, and really it wasn't a whole lot of good news to digest, right, the last few days or so. But keep in mind, the Nasdaq Gold Dragon still hit that 1-month high overnight. But whether it was the bad data, whether it's the new home prices, we're still watching very closely what CGB yields are going to do. It looks like they could be extending that drop here this morning. There you go. We're down some 2%. Are we eyeing a 2% level for the Chinese 10-year yield, Dave? That certainly is a question. Futures, though, are flat. Some strength in the currency as well.
Yeah, I mean, just to add to that, too. So this open we're seeing in the CGB market today. So that's now 1, 2, 3, 4, 5, 6, a 7th straight day of declines across CGB yields. So we'll continue to track that, obviously, as markets discount the disappointing numbers that we got over the weekend. So that reopened today. A couple of things, right? So we're just 6% away on the CSI 300 from taking out the low in 2019. And that will take you back 8 years. So 8-year lows might not be today, but certainly very much in the conversation if the direction of travel remains the same these next few weeks or so. We are extremely close, though, on the Shanghai comp, which possibly opens at a 4-year low. 27.02 is the level you want to watch. That's the close. That's the low that we hit back in Feb. We talked about, of course, where we are with the Chinese currency and CGB yields. We also did get a 7-day repo rate and that drop there as well. And so we're also very close there, I think, to 2022, 2023 lows as far as that's concerned. And speaking of rates, we are in the window, of course, for this 1-year MLF. So all things, of course, as we approach a reopen, 25 minutes away.
Yeah, let's get to, of course, our top story here. And it's really about where we are, right? It's seriously a toss-up. If you look at what markets are pricing in, right? Market implied odds are still suggesting it's more than a 50% chance of a 50 basis point cut. But if you look at what the economists are saying, and it still seems like it's a very heavy consensus there that's going to be 25.
Yeah, so conservative as far as the economists go. The markets seem to be pushing the envelope here that the Fed can and maybe should do more. It's probably somewhere in between. You know, if it's at 25, do they signal preparedness to do more? The conversation as well is, how have we gotten so close to a Fed meeting and really not have a really good idea of what they're going to do? Anna Wong, our Bloomberg Economics, from our Bloomberg Economics team, effectively put out a note Did the Fed implicitly endorse a bigger move because of the absence of pushback on market pricing, and because we don't have the pushback, and hence we're trading at over 50% odds of a 50 move? That might be an indication that they might actually be open to a 50.
And why Anna Wong is saying, it could still be 50 today, it's because, yes, the lack of pushback is one thing. Also, that maybe there's a signal to be sent here that this is a preemptive move, given the cooling of the economy. What Jay Powell does, and has to assure the market that it doesn't mean that the Fed knows something more than what what markets are suggesting here, that maybe things are slowing down more than they thought. But that's going to be what Jay Powell has to do. And I think one guest had said it's must-see TV.
Yeah.
This presser later on today.
Yeah, Jamie Dimon also earlier on chimed in on this conversation, which markets have been over-obsessed with, I should say, the last few days or so. Here's what Jamie Dimon had to say about that.
It matters to me because I have to listen to all that people yapping on TV all the time about something that's almost irrelevant. I mean, they're going to do it, 25, 50 basis points. It's not going to be earth-shattering. It doesn't mean that much. I mean, I think they need to do it. So I'm not, I think Jay Powell does do a great job, but it's a minor thing.
Let's bring in Bill Lee, Chief Economist and Executive Director at the Milken Institute, joining us from their Asia Summit over in Singapore. Bill, good morning, and I'll try and speak over the noise. I know it's fairly lively there where you are. Will the Fed drop and give us 50?
Well, the Chair Powell has been very famous for being opaque about how he's doing things. He's been keeping things close to the chest very, very long time now. And the one thing that you have to learn about the Fed is that it claims it will never be pushed around by the markets. So if the markets are advocating for 50 and they believe that they want to do a gradual approach, and that's where the consensus is, they will do a gradual 25 basis point approach just to show that markets are not pushing them around. But I, as one economist who's in a minority, think that we really should do 50 because it's time to get back to a more neutral stance, and we're way above that now.
Do you think a 50 basis point cut, though, Bill, would send some panic across these markets, that maybe the Fed knows more about this economy that we don't know, that maybe things are slowing down more quickly than thought?
That's always the pushback against the 50, and I would have said that's true about 2 or 3 weeks ago, but right now the markets have so priced in 50, in some ways they'll be disappointed by anything less than that. So I don't think there'll be any sense of the Fed knowing something that the markets don't know. In fact, they're going to be pushing very hard for 50 and getting on with getting back to neutral, which is really about 200 basis points away.
Okay, well, Bill, since you... Okay, so let's talk about that concept. The notion that the Fed is behind the curve could mean a wide array of things, right? It could mean the Fed is 1 or 2 meetings behind, or it could also mean, to the other extreme, they're not nearly close enough to prevent a catastrophe. How behind the curve do you think the Fed is?
There's no way the real economy is on a knife edge going toward catastrophe. There have been no layoffs in the U.S. economy, even though the unemployment rate has risen from 3.5% to 4.5%, and that's because more and more people think it's a good time to look for a job. And as far as inflation is concerned, the latest data points and the whole series of data points that the Fed has received and has been waiting for all this time has really put the nail on in the coffin about inflation resurgence. So right now, we're in the very sweet spot where the Fed has a lot of optionality, and as an economist, what says what the Fed should do is 50. As an economist who's trying to say what the Fed will do, it's likely going to be 25, just to show they're not getting pushed around by the markets.
Bill, what would lead to something that would worry you in terms of the downturn in the U.S. economy? If it's not inflation, if it's not the jobs market, is it going to be the consumer that we have to watch out for?
Absolutely. In fact, if there's any weak spot in the U.S. economy at all, it's where consumption is coming from. About 40% of consumption is being done by about 25% of the population. That's because even though we've had a tremendous amount of job growth, the jobs that are being created have really lower and lower income. They're in hospitality and leisure, and we find that households are having to get 2 or 3 jobs just to make ends meet. So it's really the very rich that has savings, especially capital gains in the stock market, that is accounting for most of the savings. and the stock market is owned by the top 10%. 70% of the stock market and pension funds are owned by the top 10% of the U.S. population. And if you add another, the 40%, that accounts for about 3/4 of the, almost 90% of all the stock and assets that are owned by the U.S. Consumer.
Okay, well, the prospect of a, well, I think two-part question. Do you think the U.S. could enter a recession by the end of next year? That's one part, because that also is at around the same timetable where Fed fund futures see the end of the easing cycle. And how deep do you think this easing cycle needs to be, Bill?
It's inevitable the U.S. will enter recession, but to time it, to call it within the next year, I think is a bit of a stretch. The data so far have been very strong. As I said, the weakness that we see is in the share of consumption that's in a smaller and smaller base. But we also know that conditions as the Fed is easing over the next year will be helping the interest-sensitive sectors, especially housing and investment, and it'll let people be able to feel a little bit more comfortable about spending. So I think we are in a pretty good shape, and the prospects of recession, I think, are pretty low going forward.
Bill, you've been traveling around the region. As you mentioned, you were in Korea, now you're in Singapore. What are conversations like with people on the ground right now? Is it all about central bank policy, or are you hearing more fielding other questions right now?
There's an obsession about what's going to happen to the U.S.-China tensions vis-a-vis trade policy, especially for countries here in ASEAN, because I think that there's a clear sense now that, and I'm really impressed that the Asians have sussed out that Trump means more bilateral deals, and Biden-Harris is a continuation of these multilateral deals. And where the countries like Singapore and Korea and ASEAN will fit, and how they will change their strategic trade policy, will depend upon who's in charge and what kind of deals they'll be struck. And I think a lot of countries are looking forward to more bilateral deals, because that's where they can get customized, tailored trade policy that'll be appropriate for both sides. And there's a lot quicker to do than the multilateral trade deals.
Right, and Bill, speaking of trade policy, I mean, the other angle to that story that we over-obsess about as well is, China's been exporting its way out of the economic doldrums right now, and there's a notion right now that, external demand, particularly out of the U.S., might start to weaken as the economy softens there. Do you see trade policy tightening against China?
It's unfortunate that China's counter-cyclical policies have been so ineffective, and that's because they've been shifting their emphasis more and more onto the supply side rather than the demand side, where we really need some relief. President Xi has an aversion for direct household transfers. So we have the sense where we have deficient demand, we have debilitating debt levels that prevent local governments from spending, and also dismal demographics that's holding back growth in the long term. So China really has a lot of headwinds to deal with, and the fiscal policy they put in place is the wrong place. The U.S. showed in the 1930s that supply-side policies are just not enough.
What do you want to see from the Chinese authorities then, Bill?
I think they have put in a lot of fiscal policies that are really quite good, in the sense that they put in swap policies to try to swap out a lot of the local government debt to try to bring some relief to the local governments. They should do much more of that, because it's the local governments that are able to actually spend and entice more investments. The other thing is more of the private sector. So far, a lot of the boost has been to the state-owned enterprises, and President Xi has really emphasized new technologies, quality growth, but it's all coming from joint ventures with state-owned enterprises, and that's not the way to encourage innovation. Innovation has to be encouraged by the markets, and rather than being state-led.
Bill, it's a pleasure to have you here in Asia. Bill Lee, their chief economist and executive director at the Milken Institute, joining us live from Singapore. Yes, and just given the backdrop of this, right, we're getting into this Fed day, and really what you're seeing is crypto is doing quite well. We saw the best day in more than a month when it comes to Bitcoin. You take a look at how things are going. We pare back a little bit of that rally, but certainly there's signs that really the expectation of Fed cuts is really leading to more demand for some of these assets here this morning. We are trading trading above that 60,000 level for Bitcoin. Ether, though, getting a little bit of a pullback there, but we're still trading around 23.18 levels here right now. And cryptos, of course, are the focus at the Token 2049 conference, also in Singapore as well. That's where our tech reporter, Annabelle Jewelers, is live this morning. Belle.
Thanks, Yvonne. Yeah, this is Asia's biggest cryptocurrency event of the year. There are a lot of well-known names, well-known businesses that are present here today, but the focus this hour is going to be on what's dubbed the fourth generation of cryptocurrencies. As you said, we are seeing more optimism perhaps coming back into the space, perhaps also being a little bit held back by a lack of regulatory clarity, a lack of mainstream breakthroughs as well. But this hour we'll be speaking with Charles Hoskinson. He is the creator of the Cardano blockchain. That's a technology sometimes dubbed an Ethereum killer. We'll discuss the outlook for that chain, why perhaps some of the optimism around it is not being reflected in the price of it. More ahead this hour, as we said, with Charles Hoskinson, Import-Output co-founder and CEO. This is Bloomberg.
Right, and ahead of that crucial, much-awaited, much-debated central bank decision out of the Feds, we are also going to get the reopen of markets in mainland China, so everything from CGBs, and as you can see, we're down again on yields, 205 right now. That's the seventh day of declines in yields. Futures are pushing lower. On the Shanghai Comp, the level you're watching is 2 points below the last close at 27.02. Below that, we open at the lowest since 2020. The fix of the day is out, strongest one of the year so far out of the PBOs.
Yeah, and they missed out on a lot the last two sessions, right? Whether it's that bad eco data over the weekend, and let's bring in our senior equities reporter, Abhishek Vishnoi, with the latest. Are we set up for a pretty bad open here today? I mean, we were taking a look at some of the moves, Abhishek, in Hong Kong, which is quite positive the last few sessions on the back of more growing expectations that the government has to step up and do more.
Yeah, I mean, it looks like that. There might be some positive cues. Markets may react initially positively to HSCI rising about 2% over the two-day holiday till Tuesday. But, things are pretty bad for mainland equities. I mean, the onshore gauge is trading at 5-year low. It's looking at lowest since 2017 if it falls 5-7% more. And it's not like we have not been here before. We've been here at these levels in Feb. We have been here last October. And, the growth target has been under duress since then. But the government has been pouring just cold water on expectations of big bang stimulus. So here, again, the setup is that markets, investors really want stimulus, bigger, bolder steps to come in. And if that happens, we might see a tactical rebound again. But, this is still remains a sell-on rally market. I mean, buyers have been on a strike in mainland equities. There is no participation. So investors are really hoping that government does something different and bolder this time around.
Yeah, well, and there's also there was, I'll use the past tense here, there was hope that an easing cycle from the Fed might help the fortunes of, this greater Chinese equity market. And now we're this close to the easing cycle beginning. It doesn't seem the market is reacting at all to perhaps lower rates ahead. How are Chinese investors bracing then for this Fed move?
That's right. A Fed cut, a Fed's pivot to rate easing cycle would provide China more room to carry out a bigger stimulus. Yuan strength can, may have further to go. But, it all depends on how much cut comes in, actually. And that's not just a setup for China. I mean, a 50 basis point cut that investors have been pricing in for a while now, and that doesn't have a very good track record if a rate easing cycle begins with the 50 basis point cut. So that is the backdrop there. And China is unlike any other economy at this point. It's facing a whole host of issues. Deflation is getting entrenched. Consumer is just not spending, or there is down trading of consumption happening. Property crisis remains far from being resolved right now, and Western tensions are only going to rise, after U.S. election. So, given this setup, one can really hope that a big, really big stimulus on fiscal side as well as on monetary side comes in, and then this economy and stock market correlation, which has increased tremendously over the last 3 years, breaks down, and China finds its path towards some sustainable sort of gains.
Abhishek, thank you. Abhishek Vishnoy, our senior reporter for equity markets in Singapore. For us, futures are pointing down ahead of the reopen today. Just one thing to note, we are in the window for MLF, of course, operation here. The PBOC just coming out and basically saying that this whole chunk that expires today will be, I'm going to say rolled over, will be renewed in about a week's time. So September 25th is the date. Mark your calendars. Now, the reopen, under 8 minutes away. This is Bloomberg.
I see investing in China as largely a very attractively priced place that now has a lot of questions regarding the issues that I've just referred to. In other words, the economic issues and the political issues regarding property rights and whether it's still glorious to be rich and how that'll work. Therefore, there's a small percentage of our portfolio which is in China and will stay in China, through this process.
And that was Ray Dalio there, Bridgewater Associates, speaking with us earlier on the sidelines at the Milken Asia Summit that is, of course, taking place over in Singapore. Going into the open today, reopen on the mainland. We've been shut for Monday, Tuesday. Hong Kong was open Monday, Tuesday, and is now shut this Wednesday. So we're alternating between these markets. A50, well, this one is the CSI 300 ETF that trades in the U.S. If this is a proxy, most approximate proxy, this one is up 0.5% from Friday. A50 futures are also up. Last we checked, it is, of course, trading right now. Just have a look at how that had been trading while the mainland was sleeping. And we're looking at that. Flip the boards, please, if we can. That should be down a little bit, 0.3% right now. 1186, up 0.5% still. Over the time frame, the 10-year yield is what we're watching very closely here.
Yes, so continue to see the declines there when it comes to CGB yields on the back of that weaker data that we got over the weekend as well. And we're really watching those key levels, whether it does break below that 2% level here right now. We got the open coming up next. This is Bloomberg. Welcome back. You're watching the China Show. Of course, we're counting down to the reopen of mainland markets here today after that Mid-Autumn Festival. So watching very closely how markets are going to react to a slew of bad news that we got basically the last few sessions. But Hong Kong markets are shut. We went into this holiday really seeing a bit of a rally overnight. So we'll see if mainland markets follow through in any way. But we're continuing to watch those CGB yields. There you go. We're down some 2 basis points here this morning. Dave.
Yeah, that's really where we're seeing so far the reaction, if any, to the soft numbers which came out over the weekend. Plus, of course, not to mention the typhoon, of course, that went straight to hit Shanghai earlier in the week. So there's that. There's this drop, as Yvonne is pointing out, in CGB yields. I think we're down 7 days now in the 10-year yield. Although on the bright side of things, as you look at the open today, there's several levels to watch. Hong Kong equities have actually done very well. We're up, I think, 6 or 7 straight days on the HS Tech Index, up 5 or 6 on the Hang Seng. Those markets are closed. Today. Of course, we are shut today here in Hong Kong. At the reopen, we're down on Kweichow Moutai, but some of the big ones, as you can see, are still at least above water ever so slightly. We're opening a little bit higher compared to the close that we had on Friday. Speaking of yields, we're down a further 5 basis points on the long end. On the 30-year yield, we're down about 2. We're coming off lows, though. We had a 204 handle earlier on the 10-year yield, so maybe just a little bit above that level. A couple of markets and a couple of stocks that we're tracking here today, certainly just on the back of a lot of the moves we saw in the H-share market in Hong Kong. So, stocks that did very well. Zijin Mining did very well. Postal Savings Bank, ICBC. So it's really some catch-up moves we're seeing in the A-share market there. Midea Group, of course, was that big listing we had yesterday, did very, very well on the first day, up 0.4%. Higher Smart Home, unchanged. This was actually the underperformer here in Hong Kong the last 2 days or so. Right, one level to watch, CSI 300. So we closed at a 5-year low on the benchmark on Friday. Something to watch perhaps over the next few days. So we took that low out. The next level to watch is the low back in 2019. We're still above 6.2% from that level. So a couple of bad days away if we do head in that direction. Below that, we're back to levels last seen, Yvonne, in 2016. And hopefully we don't get to that point.
Yeah, hopefully we'll see how things fare. It seems like right now things are pretty slow going. We'll continue to watch this one. But we're checking FX markets still, where you're seeing a lot of volatility overnight. In particular, it's sort of this sudden surge in the dollar that's really come back into play, which is hours ahead of this Fed decision. So what does this tell us here right now? We basically saw dollar yen jump overnight by the most in a month. So we're taking a look at 141 levels. We're paring back a little bit now. So the yen coming back a little bit just right now. But there you go. A lot to unpack here. Let's bring in our FX and rates reporter, Michael Wilson. He joins us now. Michael, it's interesting, right? This relentless rally we see in the yen seems to be hitting some, I guess, fatigue right now. Where to now for dollar yen, you think?
Talking to a few guys up in Tokyo, some of the big Tokyo banks, they still prefer to sell dollars on a rally, and it probably plays out if we get a dovish 50 out of the Fed, regardless of what BOJ do. But if you're playing that sort of narrative, and I think today we saw evidence that it was people were reloading those dollar shorts. The diehards who wanted to get a trade on before the Fed. But that moved down to 139.58. I think equally it could be seen as probably a bit of late capitulation, and people getting squeezed out of their yen shorts. But the way the hedge funds came into London and bought it back, they obviously thought it was far enough in such a short space of time. They'd probably been short about 1,000 points higher, and so it made sense heading into a risk event to buy it back. And so that squeeze that we had, some of it was, retail sales, fueled, and that's fine. I think the reaction function in the FX market was probably a little bit bigger than, say, the bond market, where the boys are still holding onto their tickets. Pricing still around, about 63% or something for a 50 basis point cut. Now, if that doesn't eventuate, that will certainly give us the volatility that we've been looking for, and I think that you could be in for a very, very choppy session. My bias is to sell a rally into this if there is one. I think that the Fed will, they've boxed themselves in quite a bit at this stage. They've allowed the narrative to get away from them, as it were, with the way that market pricing has run with it. And it's going to take a pretty super effort to have a dovish 50-point cut. If they don't deliver in the statement, in the commentary, then I think that there's some scope for maybe a bit of a squeeze. Certainly not one and done, but if you go 50, then 25, it just doesn't gel, doesn't make sense. So they might be better served to maybe go at 25, and that's where you could really see a further bounce in dollar yen, and I'd probably sell into that one at that stage, having regard to the fact that we've got Bank of Japan coming up on the Friday. So it's going to be a choppy event, and I think that the last 24 hours have just been people mainly getting out of their positions more than anything, and only in the last, say, 6 hours, a couple of dollar shorts have been reloaded.
Yeah, and in between that, we have other central bank decisions, including one from the Bank of England, and no change expected there, Michael, but certainly we're moving into this, 36, 48-hour window where many things could happen depending, and just to add to what the Fed officials say and what the dots also show going into the end of the year. Does it, it looks like we're cleaning out some of these positions ahead of the Fed. Does it seem like markets are overly light on dollar allocations at this point in time, Michael?
I think a lot of that positioning has definitely been lightened up. So what we're looking for from the Fed is some clear guidance where this rate cutting cycle bleeds well into the first half of next year, and then that may indeed give us the next leg in the overall dollar picture lower, which is what we're searching for. But if they are non-committal, I think it'll take a while for that positioning to rebuild. It'll be a complete reversal of the carry trade, obviously, but I think that you're going to have a situation where if BOJ set the market up for an October hike, and the Bank of and the Federal Reserve only go 25. That's not a bad result. You'll get a rally in dollar, and then they'll give the positioning a chance to swell, to something that becomes a bit more tradable. And a bit more conviction, because right here, right now, we're just, it's bounced too far to buy a dip into. People want to buy it, under 140. They've seen the price action there. Conversely, above 145, I think there's a queue in Tokyo waiting to sell it if they see it. So, you're quite right, David. The positioning has lightened up, and probably rightly so, because the uncertainty is certainly picked up. I see one-day volatility is up near like 24, 25. Into the Fed. Admittedly, it's not as high as it was, I think, back on August the 5th when we had that crazy day in the Nikkei. I think it was just sub 40 there, volatility. So the market is, they're going after it, but they're not, they're not chasing it. They'll wait until the Fed declares their side, and then they'll certainly put some money behind it then. But again, I think the market needs a dovish 50, and I think Ueda is going to be looking at it very, very closely, what the Fed does, and they'll be looking at the market reaction. I don't think they want to repeat what happened last time when the Nikkei swung around like that. They try to avoid volatility where possible.
Yeah.
Michael, thank you so much. It looks like the busy days are in fact ahead. Michael Wilson, our FX and rates reporter there. On all things exchange rate. Right, we'll take you straight back here to Singapore. The Milken Asia Summit is taking place, as you can see on your screens. That is, of course, Ray Dalio, Bridgewater Associates. The opening panel, moderated by our colleague, of course, Linda Amin. Let's listen in.
100-year storm, pretty ominous, but this is the second largest economy in the world. You have to be invested in China, Chow Kiat.
We do invest in China, but maybe, just to add to some comments that Ray had touched on. We look at China as going through three transitions at the same time. The first is the GDP mix. As Ray pointed out, they have a debt problem. China is trying to rejig its GDP mix, moving away from housing, moving away from a lot of the heavy fixed investment type component of the GDP, more to consumption, more to exports, actually. So that's happening. That's one. The second is green transition. Actually, China has had a lot of success on that front, creating, of course, a lot of big companies, competitive industry in the process. In fact, in the process, helping the world to have lower costs in doing green energy and things like that. So that's the second. The third is geopolitical transition, which is difficult. And that's happening as well, meaning the country is now putting emphasis on security, on resilience, and things like that. So these are the three transitions that I think we have to look through as the lenses to find places to invest. So we are continuing to invest in China. Deal flow has been extremely slow. Markets are having low expectation in terms of the macro of China. This might take a while, for things to work through. But certainly as the second largest economy in the world with great entrepreneurs, is a place that we cannot miss out. On Ray's point about diversification, indeed, I think that's now coming out to be I would say a common challenge for a lot of investors. As the ambassador said, the US has done so well, right? It has the talent, it has the capital, it has the market. As a result, if you look at market composition, the share of the US has gone up significantly. Almost 70% of the world equity market is the US. That per se is not a bad thing, except that I think everyone has to consider carefully whether, right, your portfolio being so exposed to just one particular country, is something that suits your objective. So as Ray said, I think on sort of most cases, you want some balance in your portfolio.
Speaking of the U.S., we have to talk about the U.S. election, 49 days and counting down. How much clarity is there in terms of possible policies that would impact the investment environment, that would impact relations with China, and how you should be investing your money?
Well, I have my guesses, but
do you want to share your guesses?
Not quite.
There are only two.
But really, I mean, the more important issues are those, trends on taxes, immigration, big policies, regardless of who, goes into the White House. The U.S. does have a huge private sector that offers still a lot of good assets for us to be investing in. So the U.S. is certainly a very, very key market, regardless of what happened, in the coming election. We find many businesses, in different parts of the U.S., which we previously had not really, heard of even. So I think that continues to be a place that we are active in.
The U.S. has become increasingly nationalistic, applies protectionist policies. How is that going to play out, whoever comes into power? When Biden came to power, we thought he would unwind the protectionist policies of Trump. But yet the opposite happened. So what are you anticipating?
Again, there's so much that's positive in the United States, and rule of law, the capital markets, so many different things. Fantastic in many ways. However, I just want to again emphasize that there's a lot of risk because a limited number of companies constitute a lot of the performance in a country where we have to be concerned with the possibility of the orderly transition of power. I mean, presumably there is, but if you get into a situation, I remember my history and seeing these things happen over and over again reminds me really of the 1930 to 45 period when, four major democracies turned into autocracies or something. They're conflicts. We have that surprise risk, let's say. Then when you go beyond that and we think about that, there is a big difference between essentially, let's say, capitalism of a certain type and socialism of another type. I mean, so there's a classic left-right conflict. That left-right conflict is going to have significant implications for the markets, for a lot of things. So I think we are in an environment where there's the normalcy, and if we say everything goes on normally, we have a fairly balanced economy and so on. And then we have lurking over that the elections, the debt issue, the geopolitical issue that we are uncertain about. The markets now are priced for wonderful things, by and large. And so we can't exclude the possibility that we don't have wonderful things. And that is the reason why any of us, we all talk about the issue of diversification. How do you diversify in such an environment? So the elections are a risk. I think the most optimistic that you can say about the elections is you're still going to come out of it with, in many cases, irreconcilable differences, not just about wealth, but about values. Can a 10-year-old child decide what sex it is, or issues about abortion and so on? These become irreconcilable differences. And is that going to cause the changing of the number of Supreme Court justices? How will this game be played? So it's a very uncertain time, at a time where the assets are priced, it would seem, relatively appropriately, perhaps a little bit expensive, with the risk being more on the downside, it seems to me.
So a lack of clarity, but it does seem clear, though, Ray, that whether it is
All right, let's take you back to the Token 2049 conference in Singapore, where our very own Belle is standing by with our next guest. Belle.
Thanks, Yvonne. Yeah, I'm joined here this morning by Charles Hoskinson. He is the Input-Output co-founder and CEO, and of course, someone who's well known in the space for being the creator of the Cardano blockchain or protocol. But let's just start off with what you're here to discuss today, which is the fourth generation of cryptocurrencies. We were just speaking earlier about the sort of five main pillars toward mainstream adoption. There's scalability, interoperability, there's governance, privacy, identity. How many of those do you think have been solved for, and what are the key areas that are outstanding?
So we're in the middle part of the third generation of cryptocurrencies. The first was Bitcoin, the second is Ethereum, and the third generation are things like Solana and Cardano and Tezos and Polkadot. And we're making great progress on governance and scalability and interoperability, but the last mile for the trillions of dollars of real-world assets, the last mile for mainstream adoption of crypto is really privacy and identity. The identity gives you the ability to do regulation, account recovery. If you lose your crypto, how do you get it back? Dispute resolution. And the privacy allows you to finally be able to keep secrets, which every business in the world requires for their logic, whether it be HR or medical records or your contracts or these types of things. So we're making great progress as an industry, and there's a lot of compelling and interesting projects, but I can't wait. It seems like the next generation is going to start in 2025, 2026, and if we get that done right, we're probably going to bring the next billion people into the cryptocurrency space.
What is the issue then that Cardano is solving for in the process now?
So Cardano came in, we started in 2015, and we've been around for 9 years, and we're deep into the third generation, so we're tackling scalability and interoperability and governance. In fact, the last 2 years, we've been heavily involved in governance, and we try to learn how do you actually build a blockchain-based government with people in more than 100 countries and get a constitution and on-chain representation, because the issue is you don't really have normal product management. Normally when you have Windows, you have Microsoft, when you have the iPhone, you have Apple. So like who decides for a blockchain if it's a decentralized protocol? The only way you can do that is if the holders of the protocol themselves have some form of government to make that type of decision. And it turns out it's really hard to do that when you're talking about people from 100 countries. So that's where we're at as an ecosystem, but also the fact that we have those capabilities gives us the ability as an ecosystem to launch new projects. So we have a project called Midnight, for example, and its core focus is to be that fourth generation concern, to kind of bring this space together and bring in privacy through private smart contracts and identity, so we can start talking about automated regulation, we can start talking about account recovery, we can start talking about that private business logic, which is kind of that last mile for business adoption, government adoption, and consumer adoption.
That decentralized governance structure that you're talking about, which is sort of unique to Cardano, is that something that is a positive or a negative for institutional adoption, do you think?
I think it's a massive positive because you need to have consistency of governance. And so when you have a single entity, a single actor that's in charge of something, what happens if they get arrested? What happens if they die? Look at SBF to FTX or Do Kwon to Luna or these things. One bad actor can destroy an entire ecosystem if they have too much power. So any good governing structure, like the Linux Foundation as an example, you have hundreds of companies and different members come together and they work together for a common interest. And so suddenly you can have IBM working with Microsoft and Microsoft working with Apple and Google and Samsung, even though on the outside they're all commercial competitors. So protocols need this. They need good governing bodies and good governing institutions. And once you have it, you get consistency, you get reliability and stability, which is what is required for Fortune 500 government adoption. And no nation state is going to put a voting system on a blockchain if they think it's not going to be around in a year or two. So they have to have faith in its credibility. The challenge is how do you build that in a way where it's fair and inclusive, and it's also efficient and effective, and it preserves the integrity. It's really hard. As we see in America, we're not exactly happy with our government. If you see in Europe, there's a tension between the European Union, the local member states. So governance is one of the hardest things to do, and the cryptocurrency industry is not immune to that reality.
What about the tension then in your own sort of space? Because Cardano is something that's been called an Ethereum killer in the past. There's obviously competition between Cardano and Solana. Do you see any area for cooperation?
Right. I think that's what the fourth generation is about. If you can embrace multi-resource consensus, what you can do is start paying staking rewards to multiple blockchains at the same time. And then all of a sudden the chains start looking like partners with each other, and they actually have financial incentives to care about each other. You can't get people to partner if it's not in their financial best interest. People have to see emergent value in relationships. And the problem with cryptocurrency tokenomics is they create an incentive for people to fight each other and hate each other, even when it makes sense for them to work together. together. So this is the last mile for our industry to resolve, because once we solve it, then all of a sudden, instead of opposing each other, we're attracted to each other very naturally. And we've proven already that we can move very quickly as an industry. In just 15 years, we've gone from a single person building Bitcoin to this gargantuan $450 million, $2 trillion industry. And that's mostly because of that decentralized coordination.
We just had an interview earlier with Kiat from Animoca Brands, and he was talking to me about how there's been something like 2 million new tokens issued this year alone. That dilutive aspect that comes off the back, has that been a challenge for Cardano? Because, for instance, in terms of market cap, it has slipped out of the top 10. Do you see a path back into the top 10?
Oh, absolutely. You know, there's ebbs and flows. We've been in the top 10, out of the top 10 for the last 7 years. And really what I look at is when people come, do they stay or do they leave? We have one of the most loyal and evangelistic communities. And the fact that decentralized governance is turning on and there's a $600 million treasury that's available, it's going to be able to actually start making strategic investments in marketing and branding and growth. And the issue is that a lot of the growth that we see in these chains is artificial. These foundations give themselves billions of dollars. They invest those billions of dollars to get people to come. We saw this with EOS, we saw this with Tron, we've seen this with so many ecosystems, and there's an ephemeral nature to that. Real growth, you have to look in terms of the decades and say, are there deep philosophies of why people are there? What economic and political and social systems do they want to change? And most people in Cardano, they're there because they believe in the vision and the message of it, and they couldn't care less of the value. They were there when it was 3-cent ADA, they were there when it was $3 ADA, and they're there at 33-cent ADA. They're loyal believers in that. And just like Bitcoin, when I entered the Bitcoin space way back in the day, it was under $1. So nobody was in it for the money because we had to pay for our own coffee. And now obviously Bitcoin is a Leviathan, but most of those OGs are still in it for that sound money.
All right. Charles, of course, one of the original members of the cryptocurrency industry, but that was Charles Hoskinson, their import-output co-founder and CEO, Dave.
Bill, great stuff. Bell there, of course, at Token 2049, also taking place in Singapore. Speaking of tech, just very, very briefly, and we'll talk more about the market story in a moment ahead of the Fed. Chip stocks are on the move on the mainland here. As you can see, limit up in some cases on the back of this report that China might have had this equipment breakthrough as it pertains to lithography machines here. More on that story and more coming up.
Welcome back to the China Show. Here's a look at the CSI 300 a half hour into the session and really coming back from that holiday, and things are looking okay. We're flat, pretty much. We were expecting to see things actually head a little bit more south, just given the amount of news that we had to digest the last few sessions in Hong Kong as well. But there you go. We're still hovering around those 5-year lows, though, for the benchmark.
Yeah, very close to that. I think we're 6% from the 2019 low. And we'll see if we take that out the next few days or so. Really, the data is being expressed in the bond markets with this continued rally we're seeing in the bond market. CGB yields on the 10, coming up on your screens on the 30, also looking like a similar picture here. So we're down 7 straight days on the Chinese 10-year yield. And at some point, if not already, do we need to start talking about the 2% handle here? And where do we go as far as dollar yuan goes? I mean, certainly yield compression is one part of the conversation. The fixing came out today, first one in days, of course, because of the holiday, and the strongest fixing yet from the PBOC this year. The rest of the region looking like this. Note that you don't have trading in South Korea and also here in Hong Kong, so volumes should be on the lighter side of things, particularly because you have some of the heavy-weighted stocks on the benchmark traded here in Hong Kong. On the benchmark basis, we're slightly higher. S&P futures are in the green. Keep in mind, overnight, very, very briefly, we touched a record high on the S&P, only to close slightly below, of course, that July high. 2 and 10s on your screens. We're down by about 1 basis point on each. What's not on your screens, just to tell you about as well, is the pressure we're seeing in commodity markets with iron ore, for example, in China, down about 2 or 3% today.
Yeah, certainly that's going to be one thing. It seems like markets are certainly, I guess, awaiting. I mean, they're not really doing much really leading up to this, but certainly that surge in the dollar overnight is something that we're dealing with. Is this sort of the buy the rumor, sell the facts sort of scenario that we're seeing with the dollar here right now as well. Our yen is where we're seeing that being expressed here. But yes, we talk about how rare it is to go into a Fed meeting where we don't really know what the Fed's going to do. Usually we know at this time that it's pretty much a consensus call. And it's different from what the economists and what you hear from these banks and what they're going to say, which is basically, an overriding majority thinks it's going to be 25 basis points. The markets seem to think, nah, they got to go for a bigger move. We're talking about more than a 50% chance now that we could see that deeper cut later on today as well. Anna Wong from Bloomberg Economics certainly tries to lay out that sort of case for a 50 basis point cut.
Yeah, what she said was, the Fed, even though they are in the blackout period going into this meeting, they had the capacity to push back on market pricing, which they did not, which implicitly means that they could be endorsing market pricing around possibly a 50. But, when you look at market pricing as well, it's not as if that is completely one-sided too. 58% is still a coin toss, so it's very difficult. Do we get also a dissenting vote out of the Fed? Esther George was the last one to do a dissenting vote back in as things were moving on the way up. I think she dissented against the 75. She thought 50 was better. So it's really about what they decide, what the votes look like, what the dot plot looks like, and of course how he phrases. If they move by 50, he needs to be very careful, Jay Powell, not to give out a sense of ultra urgency, I guess.
Yes. That to show that this is a preemptive move, as Anna Wong and her team have said that, right? That they're just doing this now just to, in light of what could happen with the labor market. But it's interesting, right? We heard from various guests here in the last few hours, whether it's Ray Dalio, Jamie Dimon, Bill Lee. Dalio thinks 25 basis points could be good for credit markets. Bill Lee from Milken Institute thinking maybe 50 could be right, too. Take a listen.
25 or 50, it doesn't make a difference. I think that's the problem with the news cycle and all of this. They're losing sense of the bigger picture. 25 basis points is going to be would be the right thing to do if you look at the whole picture as a whole. If you look at the mortgage situation, which is worse, and that affects more people, then it's probably 50 basis points.
It matters to me because I have to listen to all that people yapping on TV all the time about something that's almost irrelevant. I mean, they're going to do it, 25, 50 basis points. It's not going to be earth-shattering. It doesn't mean that much. I mean, I think they need to do it. So I'm not, I think Jay Powell does do a great job, but it's a minor thing.
The one thing that you have to learn about the Fed is that it claims it will never be pushed around by the markets. So if the markets are advocating for 50 and they believe that they want to do a gradual approach, and that's where the consensus is, they will do a gradual 25 basis point approach just to show that markets are not pushing them around. But I, as one economist who's in a minority, think that we really should do 50 because it's time to get back to a more neutral stance, and we're way above that now.
All right, more yapping now.
Unfortunately.
Unfortunately, we have to do this for the next 2 hours. Let's bring in Ben Emons. He could join in on this whole debate. CIO, FedWatch Advisors. Ben, does it really matter if it's going to be 25 or 50 today?
So let's yap, Yvonne, that it is something that I would say, like I wrote about it, like it's the biggest rate cut in the room, right? In the analogy of the biggest elephant in the room. Because let's face it, the biggest central bank that starts to lower rates, and that's going to impact global markets, and we're seeing it playing out as we speak. Chinese yields going down, Treasury yields have been moving down, and stock markets seem to get a lift from it. So you could argue 25, 50, what does it matter? What really matters, I think, just the Fed doing it and moving ahead. And then the second message about like where you're going to stop, right? What are you going to move to this neutral rate at maybe indeed a 3.5% handle or about, maybe higher? I think that's a big important question we're going to see answered tomorrow in particular, because the speculation we're seeing currently is just, I think, people trying to position on the surprise, but it's really about where's the Fed going to ultimately end up with this rate. It's going to be lower, but how low? And I think this is the next uncertainty we face.
Okay, well, I won't ask you. Well, thank you for giving me the question then. How low, Ben?
Yeah, indeed. Yep, again on this, so the Fed has 2.5% as a long run rate. That I think is very low, because that means that inflation is back to 2%, if not lower. That's why that long run rate is being put in place. But if you look at market pricing, that's about 3.5% in these overnight index swaps, which are sort of the gauge, the proxy of Fed funds in the future, that's about 3.5%. So that, I think, is a reasonable gauge, because that number, David, has been in place since the Fed started raising rates in March of 2022. So the market assessed, like, if you're going to go to cutting sometime in the future, then that may be your say, neutral rate. So I think that's the rate to look at. Where how fast we're going to get there is then that next question, your next question.
Well,
come on, Ben.
You're setting it up very easily for us. How fast then, Ben? I mean, the markets are pricing in, 120 basis points of cuts for this year. Do you think that the Fed's going to deliver on that, or do you think that it's going to fall short of that?
It could fall somewhat short of it, Yvonne. But there's something what Bill Lee said from Milken that I think is a good point. The Fed has put in place a rate that's restrictive. And if you measure that restrictive by just taking the Fed funds rate and the counter for headline inflation or core inflation, just this year, that real Fed funds rate has moved up by 100 basis points. Now, that's a lot of tightening. And if you add in what the balance sheet has done too, which there's some calculation what the Fed funds rate would do, that's another sort of 50 to 75 basis points of additional tightening. I think that's the level of tightening, say 150 basis points to be even, that they could remove and could potentially remove in a short order, if particularly the labor market shows more weakness. I think this is what Waller said very clearly of that front loading of rate cuts, just like they front loaded rate hikes. You see the signs of the unemployment rate moving more up. They just don't want to fall behind that curve, right? They want to get ahead of the labor curve. So I think 150 basis points is the restriction they take off. If the employment rate goes to 4.5, you can expect that 150 basis points to be removed in a few meetings.
Ben, where do you think Treasury yields will go short term?
So it's really interesting, David, that once again, we're with the yield curve a lot lower now, around 3.5%, just above that neutral rate that the market thinks it is, right? And the yield curve has still some inversion left, right? And the 2/10 is positive, but it's very minor, and there's some other inversions going on. So I think that's where we currently are, go to the bottom. I don't think we're going to go a lot lower, because if we do, then that means that inflation is going to decline a lot more quicker. That we seem to continue to be grinding low with inflation. It's really then a matter of will the unemployment rate move up quicker to 4.5%, yes or no? That could push rates down, because that would mean the market's implying, okay, Fed, you're going to move faster, right, with these rate cuts. So I think we're kind of at the bottom here at the moment. Take note, by the way, of GDP now moving back to 3%. Some of the regional manufacturing data has picked up in activity, and as well as retail sales were stronger. So there's also something of economic traction coming through here as we signaled rate cuts, as the Fed now starts to deliver this rate cut. And so I think the Treasury market will be getting a little sensitive to forward-looking indicators of how the economy is performing as the Fed delivers the rate cuts.
Yeah, is there a sense then, I mean, we saw what happened in August, right? If the Fed does deliver on these cuts, I'm just wondering, does that unwinding of that yen carry trade revive itself once again in a big way? I mean, we had the BIS just come through with a report saying that, look, it does have some further unwind to go.
Yeah, for sure, because it's a really large trade. And I know when I started working in the 90s, the carry trade was estimated something like 10, 15 billion or so at that time by long-term capital management. Today, we talk about estimations of in the trillions, 2 maybe even higher number of trillions, right? So it's a huge trade out there. And as we know, the Bank of Japan and the Fed are clearly now, for the first time in history, maybe in diverging paths, right? The BOJ will probably hike 1 or 2 times more as this Fed lowers rates. So it should lead to some level more of unwinding, if anything, just from an interest rate differential point of view, that takes some of the carry return out of the market. Whether it will be violent, we'll see. That's always an earthquake analogy, right? Like as in, I'm in California, there's a San Andreas Fault. I know it's going to have an 8th earthquake at some point, but we don't know it exactly. I think that's what that carry trade is too. It could violently unwound. But I think that has a lot to do with just the data causing uncertainty about the Fed. Hey, you are behind the curve. You got to move faster. You get a more violent unwind from carry trades. But I do think it will continue given the interest rate differential between the US and Japan really changing.
Yeah, timing the market is could be deadly, really, if you think about it in that analogy. But certainly, the longer you wait, it's eventually going to happen, right, Ben? Final question for you: the equity market in the U.S. started to broaden out months before this first rate hike we're about to get. Do you think that trend continues, agnostic of what the Fed does and says?
I think that is, because that's a notable change from the last, let's say, the period before that, when we had a kind of strong economy and everybody was really looking at AI in isolation. That was really the driver. And to an extent, it still is, right? I mean, people do react to what happened with Microsoft today, just announcing buyback and dividends. And it's part of the AI idea and lifts the markets, but the broadening is certainly happening. And that's still a view about that. Eventually, what do these rate cuts really mean? It's just taking restriction away from policy from the economy. So if you think of it that way, the economy gets breathing room here as the Fed lowers rates, which means that there's going to be more activity and more sectors benefiting from acceleration of the economy or potential re-acceleration. And to a final point on that, Bostic said this himself, that months ago they did a survey in business owners in the Atlanta area, and every one of them told them, like, if you're going to cut rates, I expect more sales, I expect to invest, I expect to hire people. So there's something about a multiplier effect coming from that rate cut or rate cuts, lifting the economy. I think that's the broadening of the equity trade that we're seeing playing out.
Ben, thank you so much. Ben Emons there, Chief Investment Officer at FedWatch Advisors. To continue the Fed conversation, really, in the context of the region, and central banks here in the Asia-Pacific are certainly set to take their cue from the Fed as they cut rates. The region, of course, attracting more capital amid the prospect of lower rates in the U.S. Katia Dmitriev, our Asia economics correspondent, joins us right now to talk us through the thinking here. So, I mean, so markets have started to pile into EM Asia on bets that the Fed will eventually cut. Will that be the case? Will we see Asian central banks follow the Fed?
It depends, and it depends on what month. I think first we have to see which central banks are kind of still worried about inflation potentially. Others might be worried about financial stability. So the rule of thumb, according to economists, is that we'll definitely see regional banks cut at least one time, at least 25 basis points through the rest of the year. New Zealand is probably going to have to move a bit faster because they're kind of teetering on the edge of potentially the third recession in 2 years. And then you have countries like Thailand, where the central bank has actually been quite cautious, and they probably won't move to cut until next year. So it just depends on, what month you're asking the question, right? Right now, I think after the Fed cuts, we're going to have the first test with Bank of Australia. They're going to be holding rates. But after that, it's really an open door. The other thing is that the dot plot is going to be coming out. Yes, the cuts are important, 25 or 50, of course, but the dot plot is also going to be telling central banks in the area what they should be expecting from the Fed. And right now their expectations are a bit all over the place for where the Federal Reserve is going to cut this year. So that'll be also very helpful for them kind of moving forward the next 3 months.
Yeah, and it used to be mostly about just FX risk, right, in some of these countries that you highlighted. We're seeing a bit of relief in Asia FX these days leading up to this Fed meeting, but things have shifted a bit. What are some of the other factors that central banks across Asia need to be balancing now?
Yeah, absolutely. Recession potentially is one of them, or could be one of them in New Zealand, for example. And it mirrors a lot of what we're seeing in other countries. So the U.S., we're talking about the labor market kind of slowing down there, but you pivot over to New Zealand and the situation is far worse. The labor market is eroding at a very fast pace. And so policymakers are thinking we have to cut actually faster than maybe even the market expects to sort of try to shore up the economy and fix that picture. In South Korea, the issue might be financial stability. And that's kind of emerging, I think, in the region as a key theme, because if people expect the Fed to cut, we are entering an easing cycle, regardless of how quickly or the size of cuts. So you're going to have that a bit of dollar weakness, and that translates into strength for Asia currencies. So instead of kind of thinking about it, I guess, as the Fed kind of opens the door for them to move, it's more like it opens the door for them to potentially wait and see how the situation unfolds, see how the rate cuts in the Fed play out, and then see how it kind of works through their labor markets as well, with borrowing and also manufacturing and trade, because that's another big thing. I mean, the election, comes kind of in the middle of all this.
Yeah.
We've got rate cuts and the election and a lot of very export-sensitive Asian economies.
All right, Katya, thank you. Katya Dmitriev, our Asia economics correspondent, joining us on what to expect out of course, central banks here in the region. And coming up this hour, we'll head back to the Milken Asia Institute, a summit, I should say, with Anindya Bakrie. He's the head of Bakrie and Brothers conglomerate, and discussing Indonesian government plans to give the private sector a bigger role in key industries. This is Bloomberg.
Right, a 3D look at Brent prices. You had a spike going into this morning. Since that point, just above the $74 mark. We've since pared back a little bit these last few hours or so. In case you missed it, wow, what a story. Overnight, Iran-backed Hezbollah is blaming Israel for an attack in Lebanon that killed several people and left thousands wounded. A string of medical emergencies were reported across the country following the mysterious explosion of thousands of pagers. Let's bring in Bill Ferries, our senior editor, to talk us through the details of the story. Bill, I guess let's start off with the basics. Get us up to speed about what we know happened.
Well, yeah, thanks for having me. It sounds like at about 3:30 p.m. simultaneously in Lebanon, hundreds, if not thousands, of pagers all exploded, burned up, killing, so far we know of 9 deaths according to the UN, but wounding thousands of people. Hezbollah immediately has blamed Israel for this, but we don't have a lot of details on how such an attack may have been carried out. There's a lot of speculation about whether the pagers were programmed to overheat and burst into flames, or if there actually could have been small amounts of explosive material inserted into the pagers during the manufacturing process. That's all the kind of information investigators are looking at. Israel has not commented on the charges, and the U.S. has said it has not been involved in this. But a big blow, and particularly a psychological blow as well, to Hezbollah members in Lebanon, all of whom seem to, or many of whom seem to be using the same brand of pager.
Can you tell us a bit more about that? I mean, how does something that is so considered to be so low technology now can almost seem like a dangerous weapon in this sort of war?
Yeah, it's been a long time since many of us have had a pager, but in this world of cell phones where intelligence agencies are able to, and companies are able to track people down to, the square meter, pagers have, in some of these more tumultuous areas, served as a way of throwing off intelligence agencies. They've been seen as a more secure, older technology, less likely to be hacked. That will probably be rethought in the aftermath of this. But it is still quite commonly used there. Again, we don't know if there was something, some kind of an explosive inserted during the manufacturing process. The New York Times is reporting, based on its sources, that many of the pagers came from the same Taiwanese company called Gold Apollo. We have reached out to that company and have not heard back so far. But that is one avenue that people trying to investigate what happened here are chasing down at the moment.
Bill, thank you. Bill Ferries there, our senior editor, with the latest what's going on in the Middle East as well. Some other big political stories that we're following for you today. Donald Trump says he will revive a state and local tax deduction that he capped during his first term if he's reelected U.S. president. Capping the so-called SALT deduction had a disproportionate impact on regions with higher taxes and property values, typically dominated by Democrats. The announcement came ahead of a rally in New York where Kamala Harris is leading the polls. The Democratic presidential nominee, meanwhile, says she wants to cap child care costs for working families at 7% of their income. It's the first time Harris has publicly spoken about the initiative in her campaign. It's her campaign's latest bid to assure voters a Harris White House would address cost of living anxiety among Americans. We got plenty more ahead. This is Bloomberg. All right, we're taking a look at when it comes to some movers here this morning, and in particular when it comes to China consumption and travel stocks. So it seems to be mostly falling here this morning after this mid-autumn holiday. You got to factor in, of course, the rain and what really happened with that typhoon back in a few days ago, and really putting Shanghai in a standstill for a day or so as well. So it doesn't look like it's good. Jeffrey's saying seasonality is considered to be weaker this year as well. So they don't expect that to be too exciting comparable to what we saw last year when we had the Mid-Autumn and National Day holidays occurring around the same time.
Yeah, and not to mention, too, like Steve and I were talking about this yesterday, Yvonne, that there's actually another typhoon that looks to be headed straight into Shanghai again, looking at the current map. So, again, weather in between Mid-Autumn and the National Day holidays coming up. Just to pivot here, mining stocks, well, one specific one in focus, it's Zijin Mining. It's both a copper and a gold mining stock, of course. It's vowing to up its presence in Canada, despite the crackdown and negative news. Of course, shares are moving up on the back of gold prices moving up, 8 shares moving up before the holiday today.
$11:29 a.m. in Tokyo. Japanese markets are heading into that lunch break. And of course, we're seeing a bit of an equity rally here leading up to this Fed meeting. BOJ follows right on Friday. So certainly there's a lot hanging, and dollar yen has been kind of swinging back and forth, really, after weakening some 1%, snapping out of that 5-day rally. We're seeing a little bit of strength come through at 141.57. JGB yields not doing a whole lot here this morning, Dave.
Yeah, looking at Nippon Steel, another update here to this back and forth. I think it's an extension. We'll get more on details on what we heard a couple of hours back. Going into the lunch break, we're up 2% on stock of Nippon Steel, a share price of Nippon Steel. More on this. So Bloomberg has learned that the company will be receiving this extension in the review of its $14 billion bid here for U.S. Steel. That's likely to push, of course, a decision on a fairly politically contentious takeover past the elections coming up in the U.S. in November. Our breaking news editor, Gareth Allen, is with us right now to talk us through this. So this extension, how likely is it going to be, and how long do we have to wait, Gareth?
Yeah, that's right. So, according to people familiar, we've learned that the committee, that's the internal investment committee in the US, has decided to allow Nippon Steel to refile its application, and that will give it another 90 days. So it essentially extends the review of the deal out beyond the end of the election. So it does take some of the political pressure off the deal at the moment. It was due to be tabled to Biden as soon as the 23rd, next Monday, and Biden, of course, has said that he was going to quash the deal. So that's probably off the table now. So it's a bit of a kicking of the can down the road, and a reprieve for a deal that may still make it over the line now.
Yeah, I mean, as you say, right, it seems like this deal, I mean, despite this extension, you've heard from Biden, we heard from Harris, we heard from Trump, all of which are actually opposing this acquisition. So does it really change the dynamics in any way?
Yeah, I mean, you're exactly right. I mean, it doesn't change the fact that it is politically not particularly palatable in the US. You know, I mean, both companies are for the deal. I mean, Nippon Steel, US Steel, both say it's a good deal. You know, the US Steel has said that, you know, they're going to lay off workers, close plants, potentially even move their headquarters out of Pittsburgh if this deal doesn't go ahead. I mean, the deal comes with billions of dollars of investment. So on the face of it, it's a good deal. But unfortunately, the political situation in the US doesn't see it in that manner. And, you know, there are still very, very big hurdles in the way to get this deal done.
Gareth, thank you. Gareth Allen there, our breaking news editor, with that update when it comes to Nippon and U.S. Steel. Some other stories that we're following for you today. Zijin Mining Group says it won't be deterred by Canadian measures limiting foreign involvement in its minerals sector. China's most valuable mining company says it will, quote, absolutely continue to seek out investments in Canada, especially junior exploration firms. Canada wants to restrict mining deals involving foreign state-owned entities in a move seen as targeting China's dominance in critical minerals. Senior U.S. and Chinese economic officials are expected to meet this week in Beijing, and that's as the Biden administration seeks to once again confront China over alleged industrial overcapacity. The U.S. delegation includes officials from the Treasury and Federal Reserve Board and will be led by Treasury Undersecretary for International Affairs, Jay Shambaugh. Woodside Energy says it has agreed to a 10-year deal to supply liquefied natural gas to Japanese utility JERA. The deal starts in 2026, and Woodside will source the LNG from its global portfolio. Speaking separately at the Gas Tech Conference in Houston, CEO Meg O'Neill says she sees significant future upside for the LNG industry.
Now, the total global LNG market today is equivalent to about 12% of coal use. So there's a lot of room for us actually to grow the LNG market, to provide that reliable energy, provide that affordable energy, and tackle climate change.
Now, Ray Dalio, the founder, of course, of Bridgewater Associates, says that the overall picture of the U.S. economy probably warrants a smaller rate cut from the Fed when they make their call, of course, later Wednesday. He spoke to us from the annual Milken Asia Summit, now underway in Singapore.
25 or 50, it doesn't make a difference. I think that's the problem with the news cycle and all of this. They're losing sense of the bigger picture. Okay, Fed policy. What does the Fed have to do? Fed has to keep interest rates high enough to satisfy the creditors, that they're going to get a real return without having them so high that the debtors are having problems. So now if we're looking at this, whether it's 25 or 50 basis points, 25 basis points is going to be would be the right thing to do if you look at the whole picture as a whole. If you look at the mortgage situation, which is worse and that affects more people, then it's probably 50 basis points.
What is the state of the U.S. economy? I mean, we're talking about 25 or 50 based on the assumptions of how the economy is doing.
Okay.
From the data that we've gotten so far, does it justify 50? I mean, what does it say?
We have a model for estimating what should be. The economy right now is very, very, very close to an equilibrium level in many ways if you're just looking at what is and you're not looking at the debt problem. And it would look like there should be a modest easing of interest rates and a move gradually to a more positively sloped yield curve, what we would call normal. It's fairly normal, except it's not normal in the way that it's so skewed. So if we look at the markets and we look at the way the population's income levels are for the various sectors, if you look at the bottom 60%, if you look at the politics, the left and the right, and the nature of what is going on, the two worlds that we live in terms of that, the economy and the values, that brings us to the...
How do you see it playing out? How do you see the next few months, 50 days to the elections, how do you see that playing out?
Well, as I say, I think that there's two questions. First, the question of, will we have an orderly transition of power? That's quite amazing. Will we have democracy work as it is? That cannot be assured, right? So, because behind all of this is that we have irreconcilable differences, not just pertaining to taxes and wealth and economic policies and so on, but in terms of values. It's how do people raise children related to sexuality and all of those things. There are those gaps. So I think we hope for an orderly transition of power. Isn't it quite amazing that we would think, could we not have that? And then we go beyond that, and then we say, what about those policies that are going to be dealt with? Nobody's going to deal with the debt policy. That's going to end up being monetized down the path. Then the question is issues of taxation, and those issues of taxation will have an important impact on the capital markets. If they're bought for after-tax returns, by and large. It's the important thing. You lower corporate income taxes, you raise corporate income taxes, it makes a difference to prices. So we're going to have those issues, a lot of issues to talk about regarding the election. I think when we go beyond that, most likely, there is going to be irreconcilable differences, and I think that you're going to see more movement to states. So there'll be a challenge of what does the central government control, and what do the state governments control, and is there an obedience in a sense. So we are coming more to a fragmented set of circumstances. What we would need, I think, is strong leadership of the middle to bring the country together and isolate more of the extremists, if that was possible, and then to make reforms.
And that was Ray Dalio there, Bridgewater Associates founder, speaking with our co-anchor for Bloomberg Markets Asia, Hezlinda Amin. We have more from the Milken coming up. Bakrie and Brothers CEO Anindya Bakrie joins us to discuss Indonesia's economic and business outlook as a new president prepares to take office. That is next. This is Bloomberg.
Right, welcome back. Let's turn our attention now to EM, Southeast Asia to be more specific here, looking at some of the currencies ahead of the Fed, also ahead of a central bank decision also taking place in the ASEAN space with Indonesia, of course. And that being said, when you look at the markets in Indonesia, of course, this is really one of the standout equity markets in the Asia Pacific for the last several years. So people talk about India and Japan. Don't forget about Indonesia. And as you can see, the stock market has done very, very well. We're at a record high. In fact, we've maybe come up a little bit too quickly of late. Some of the technicals are indicating we might just be in overbought conditions. A good problem to have as we approach, of course, this transition of power with a new president set to take office next month. Let's cross it over now to the Milken Institute Asia Summit and bring in the man, of course, who runs one of Indonesia's largest business conglomerates, Anindya Novyan. Bakrie is the CEO of Bakrie and Brothers. He's also the chairman of the Indonesian Chamber of Commerce. Mr. Bakrie, thank you so much for taking the time to speak with us. Let's start with the business environment as we watch this transition of power in Indonesia. What do you think the biggest change will be?
I think, first of all, President-elect Prabowo next month will be inaugurated, will be inherited with a strong foundation of growth. In the last 10 years, during President Jokowi, we have been growing circa 5.5%, with the inflation below 5%. So that's a very strong foundation, with a debt to GDP around 40%. So he has a lot of room to grow fiscally, monetarily, to bring Indonesia to the next phase. Now, there are at least 3 areas where he would focus in the next few years. Number 1, structural reform. I think it has to continue. And number 2, the infrastructure, digital infrastructure as well. And number 3, I believe it's the just energy transition. And along the way, he would also focus on resilience, making sure that the health resilience, food and agricultural resilience, as well as energy resilience is always intact for Indonesia to protect from the outside shock if there is.
There also seems to be this sort of plan from Prabowo that he wants to streamline some of these state-owned enterprises, allow for the private sector to participate more. What do you make of that sort of plan, and what sort of parts of the private sector do you think are ripe for more participation?
I think that's one of the things that, especially as Chambers of Commerce and Industry chairman, we support. The public-private partnership has always been the mantra for Indonesia's economy. And I think President Prabowo will continue to push that forward. State-owned enterprises is a big part of our economy, but the other 2/3 of the economy is coming from private sector, including from the foreign direct investments. So a lot of areas where the private sector, again, including the foreign investors, can take a lot of contribution and partnership. Number 1, on domestic consumption. Let's not forget that Indonesia has 285 million people. That's the 4th largest in the world, the biggest in ASEAN by far. So that's a big one to support, to participate in. And number 2, certainly the infrastructure development in Indonesia. We need a lot of sustainable capital going forward. And number 3 is the investment sector. We have $50 billion of foreign direct investment as the all-time high last year. About about 40% of it is still coming from the critical minerals or natural resources per se. But I think going forward, President-elect would like to also diversify into other sectors such as health and agriculture.
Yeah, it seems that, I mean, for Indonesia to get from, let's say, $6,000 US GDP per capita to, let's say 25,000, that's almost a five-fold jump over the next few decades. There will need to be a lot of money that's being put in place. Do you have a number in mind how much the private sector needs to help fund this almost structural shift in the growth forecast for the next couple of decades here?
Thank you, David. I think foreign direct investment is very important for Indonesia. The most important thing that Indonesia needs to show to the world is we have rule of law that people understand and respect. So the amount of money we need is a lot. The number that we hear being thrown around is that every 1% increase above 5% growth that we have been having for the last 10 years is about $80 billion. So we need a lot of money, David and Yvonne, to spur the growth. But what's interesting is that Indonesia has also a lot of resilience in terms of the capital it has. So currently, Indonesia has reached all-time high of export, about $30 billion. And this is adding into the pot of the foreign capital reserve that Indonesia has. And please not forget that this surplus of current account will continue to bring Indonesia to be resilient in any shock that may be. And we're also very blessed with the political certainty on top of the economic stability, because political certainty has a lot to do with the democracy that we have, and in terms of the welfare really help when it comes to issues like inflation and so forth. Because at the end of the day, Indonesia still has some challenges, such as still fuel subsidy and so forth. Therefore, the issue of decarbonization for Indonesia is the right thing to do, because not only we can process the critical minerals below the ground with renewable energy above the ground, but also along the process we increase the welfare with value addition from what you're saying from 5,000 to 25,000. And just one more data, in the last 20 years we've been growing 5 times as well. So we feel confidence, but of course going from middle income to the high income category is not an easy feat.
It certainly is going to be a tall order. You mentioned about infrastructure and how this is still quite important for the president-elect. He has in some ways, though, shifted away that focus on infrastructure compared to his predecessor, Joko Widodo. I'm just wondering, does that in any way affect Bakrie Group and your building plans?
So what we understand, President-elect, from our conversation with Chambers of Commerce and Industry, will continue to further the infrastructure with a $30 billion budget this coming year in 2025. But I believe he will be also focusing on soft infrastructure. For Bakrie Group, we always been supporting the Indonesian growth in the last 82 years. We are in 3 different verticals. Digitalization, which will gel in with the growth of the country. Number 2, industrialization, starting with steel in the past, but now we would like to industrialize a lot of other value-added industries, especially as Indonesia is going to the energy transition. And of course, the third one is energy. We used to focus only on traditional energy, but going forward with electrification, I think renewable energy will be a very exciting sector that can also be good for the country in increasing the welfare for the rest of the Indonesian people.
Mr. Bakrie, I also want to ask you about the new capital, of course, and conversations around, I think, first, how much is your group prepared to invest in that massive endeavor? And there are concerns that maybe funding might not be as generous from the government with this new administration. Do you think those concerns are warranted?
So I think, David, that actually shows confidence that the government can balance between public and private partnership. First of all, Nusantara, or the new capital, is being built in East Kalimantan. That's one of the healthiest province in the country, and wealthiest, And so in terms of the funding, they have also the provincial level funding, and a lot of the investors would like to come in. Now, from our group, we focus on two things. Number one, on digital infrastructure, such as the data center. And number two is the sustainable businesses, such as providing electric buses to start with for the transportation in the Nusantara capital, which is dubbed to be green and sustainable city. And of course, we also focus on the soft side of human capital by developing the first education center focusing on sustainability. And we feel that Indonesia can be the mecca of decarbonization because of all the things we've been talking about. So it makes all the sense in the world to have an education hub in decarbonization in Indonesia, in the new Nusantara capital.
Yeah, and really you've pivoted the business towards more of these sustainable and digital investments. And I'm just wondering, how much more untapped potential or gains can Indonesia really kind of gain here when it comes to downstream commodities beyond just nickel?
I think a lot, Yvonne, because nickel is big in Indonesia, but don't forget copper. In any technology that one talks about in terms of the electrification, copper will be used even more, and it is agnostic toward the technology for conveying the electricity cables and whatnot. So copper, I think, is a big place to focus on going forward in terms of the downstreaming, but also bauxite to become aluminum, as all the electrification need the body works for the vehicles, right? But I would like to also bring the attention not only on the downstreaming of critical minerals, but also the downstreaming of food and agriculture, because that can be also making a resilient health sector in the country with the quality of food, but also bringing a lot of jobs in the country, as agriculture is very much labor intensive, which we need a lot more jobs for the country as well. So I think with the government, the new one has been talking about the new free meal for lunch. It is something that a big opportunity for a lot of our members in Chambers of Commerce in Industry, because it doesn't make sense for Java Chambers of Commerce or Jakarta to support another one in East, for example, Sulawesi, for example.
Anand, it's great to talk to you again. Anindya Bakrie there, CEO of Bakrie & Brothers, joining us from the Milken Asia Summit. If you are a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function, TV Go. You can also join the conversation, send us instant messages to our team, questions to our guests during our live shows as well. Check it out at TV Go.
Right, welcome back. We're looking at some travel stocks onshore with the market coming back online after, I think this really fits two themes in one. From the long holiday, and we now have some numbers as far as from CCTV is concerned, nearly 19% cross-border trips. That's compared to the same period of last year. During this specific holiday, we're getting a pullback across some of these stocks. Might have to do with the fact that also the economic data was also on the softer side of things. Very, very quickly, medical stocks in focus as well. So I think this is a story we've been tracking all week. In fact, yesterday we did already get a pickup in some of the non-China proxies of medical glove makers like Top Glove in Malaysia on the back of the same story, and we're seeing market reaction here to the downside.
So the U.S. finalizing those tariffs on billions of dollars in Chinese goods, including those medical products like gloves, as you mentioned, so rising to 50% next year, 100% in 2026. So this is what Citi analysts are writing in that recent note as well. That's why you're seeing the likes of Inco Medical plummeting some 20% right now. We're also watching for the peso as well. Just some comments from the governor, Remilomino, though, saying that they may cut the RRR more next year. This is Bloomberg.